What's up everyone, it's Caddy with Money Investing. So in this video, I wanted to talk a little bit about the Treasury yields. The 10-year yields are absolutely going crazy at the moment, going back to the same levels from back in October of last year. And the real yields, which is after accounting for inflation, they have now gone to the highest level in 15 years from 2009. So I hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included with the link down below. There's a lot of benefits in of course, joining our community, getting access to members-only private videos and the intrinsic value spreadsheets as well. So this right here were a couple tweets that I wanted to go over. So Lisa Abramovich, real yields on the US 10-year treasuries are carrying towards 2%, the highest since March 2009. So again, real yields. And Charlie Beaulieu also mentioned the 10-year treasury yield moved up to 4.28%. I think it was 4.328%, highest since December 2007. And the real yields adjusted for break-even inflation at just under 2% is the highest since July of 2009. This right here was another tweet from Mohammed El Arain, and he says, with today's rise, the yield on the 10-year U.S. government bond closed at a 15-year high. And then Genevieve also tweeted, stocks are pricey compared to bonds. This right here is not the best indicator, though. I will talk about this in just a minute. But if you take a look at where we are with the yields, we've got 6 months at over 5.5%. 3 months are trading at just under 5.5%. We've got the 1 year sitting at just under 5.4. The 3 year is sitting at just over 4.6. The 20 year is sitting at 4.5. 5 years sitting at 4.38. The 30 year is sitting at 4.36. The 7 year is sitting at 4.34, and the 10 year is sitting at 4.2.5% at the moment. But they have obviously risen to substantial levels, back to almost where they were back in October. The mortgage rates in the US 30-year fixed sitting at just under 7.1, and 15-year sitting at just over 6.46%. So this obviously puts a lot of impact on equity prices, something that we have discussed. And why is that, right? Because the 10-year yield is the risk-free rate, right? It is risk-free because it's backed by the US government, right? If you lend money to the US government through these bonds, you are almost certain to get paid back the principal with interest over a certain period of time, of course, depending on the maturity of that bond, whether it's 1 month, 3 months, 6 month, 1 year, 5 year, 10, 20, 30. But the certainty is pretty high that you are, yes, going to get paid back the principal and the interest during that time because it's backed by the US government. So it's risk-free, right? It's considered risk-free because there's no risk involved with you lending to the US government. Now, all investments, right? That's kind of, think of that as like the baseline, right? That's your baseline investment, right? That's the least what you could make in the market with no risk at all. And right now, the 6 month, the 3 months sitting at 4.5%, 5% even, that's your baseline, right? That's what most investors need to beat in order to justify taking on risk, right? So since the bond market is risk-free and it's yielding you 5%, you need to obviously, in order to generate better return than 5%, there has to be an element of risk which is added onto the portfolio so that you can make more than 5%, right? It's simple risk and reward because there's no free lunches out there in the market. So as yields start to go higher, the risk reward shifts, right? Because then let's say yields were 2% 2 years ago. So the threshold, that baseline was 2%. Investors only needed to really beat 2% in order to justify taking risk. But now that number is pushed up to 5%. That's only one part of the equation. Another part of the equation is that the risk-free rate, which is the bond, the 10-year yield, is used in most discounted cash flows, right? When we're calculating the capital asset pricing model, which is the cost of equity for any company, the risk-free rate is used in that model, and that pretty much tells us the present value of all future cash flows. And if the risk-free rate is higher, the present value of all future cash flows is going to be lower, versus if the risk-free rate is lower, so the present value is going to be higher for all future cash flows. So that's, again, another reason why rising yields put a significant impact on equity prices and equity risk premiums as well, which, again, Genevieve is talking about. But this is only considering the forward earnings yield, right? That's the only thing. And earnings yield is simply earnings divided by the price, right? So if S&P 500 is expected to do I don't know, like $230 in earnings per share for, for the entire year, for example, and they're trading at 4,600. So we do the math, 230 divided by 4,600, we're looking at a 5% yield, right? 5% earnings yield, because we simply take the earnings divided by the price. That gives you the earnings yield. It's a reciprocal of the P multiple. But that's only taking into account the earnings yield, right? Not taking into account the price growth, the dividends, anything else. So that's why I think it's not the best metric to be looking at equity risk premiums this way, because the ERP obviously is at a 2-decade low, now sitting under 100 basis points, meaning under 1%. So stocks are pricey compared to bonds with that metric, but Professor Demodron also considers other things when it comes to forward growth. And according to him, equity risk premium, at least from a few weeks ago, was still pretty good, was still decent enough to take on risk and to be investing in the equity market as opposed to the bond market. But of course, things are changing. Things are changing pretty rapidly. And this right here is the chart between the 10-year yield and the S&P 500. And what you will notice is that most of the times, not always, this is not a 100% guaranteed chart, but most of the times when the equity, when the yields are going higher, equity prices are going down. When the yields are going down, equity prices are going higher. It's kind of like that vice versa reciprocal type inverse relationship between the 10-year yield and the price itself. So what you'll notice here is that, of course, markets kind of like not really peaked. So let me just remove this for 1 second. So this right here was back in October of 2018. You see the yields kind of peak out here. And what happened to the market? Let's just do this. Let me just pull this up a little bit. I'm going to remove the volume just so we can get a clear understanding. Let's see. All right, right here. There we go. So this right here was, again, October of 2018. Yields kind of peaked. The markets were obviously at a low. Then we started dropping here for the 10-year yields. What happened to the market? Started pushing higher. Then yields over here started pushing up. We did drop, right? This was the brief, very, very quick recession and, of course, decline for the market. But as the yields were going higher, so was the market. So again, like I said earlier, this is not set in stone. This is not something that plays out perfectly every time. But definitely most of the times it's worked out. And you'll notice that since November 21, we saw the yields kind of go parabolic, literally from 1.3% to over 4%. And what happened to the market? Obviously, we were in a bear market. And then this right here, again, is the discrepancy where yields continue to push higher over here, and so did the market, right? So, and we talked about this in one of our previous videos, that there is a discrepancy between both the yields and what the equity prices are doing. And for those reasons, I do believe that there is going to be a time where we start to see a bit of a pullback, some profit taking for the market, which again is not unlikely, something that we are witnessing at the moment. Now, yields go up. There are many reasons as to why the yields go up. Inflation expectations could be rising. So if people believe, if investors believe that inflation is going to be higher for longer, they start to demand higher yields, higher returns on their treasuries. Expectations for higher interest rates. So again, from the Federal Reserve, economic growth, if it's not going to be that strong, yields start to go higher again. And of course, supply demand of the Treasury bonds also affects yields, which I think is one of the main reasons why this is happening in the first place, is because of all the Treasury Department's new issuances as part of their fiscal policy, and the demand isn't as strong to absorb all that yet. And for those reasons, we are seeing the yields once again go parabolic. But I do also expect this to be more short-term, intermediate term. Can the 10-year hit 5%? It's possible. I don't know exactly what level it's going to get topped out at, but I do know this, they're not going to go on forever, right? So that's something to keep in mind, that eventually I do expect, of course, once the Federal Reserve starts cutting rates, if we get into a recession and inflation's back under control, that's one of the very, very strong ways to get inflation back down to 2% or lower, then of course I do expect interest rates to be back to a normalized level. But at least right now, it's definitely showing signs of concerns and putting pressure on equity prices. So I hope you guys enjoyed this video and a quick update on the yields, because this is an important topic, so don't skip on this. Hope you guys enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. There is a 16% annual discount available till the end of this month. As always, happy investing. I'll see you all in the next video.